more than any other 52-week period in the history of the data. And it goes back quite a ways. And even at the height of the crisis, investors were pulling substantially less from funds. And they were that, well, presumably they meant stock mutual funds. I've said a number of times in my newsletter and probably on this show that, again, I noticed you guys all like to make fun of me when I was gone about my market timing abilities. And it's not really forecasting or market timing, but it's my big picture view after 35 years. And I still think we're in the early innings of a secular bull market. And to me, seeing this news here, and I've said this to a number of clients and probably in my most recent newsletter, this is not how great bull markets end, when people treat every little negative 2 or 3 or 4 day event as an existential threat to the stock market and their wealth.
Now, there's a more benign explanation, though, too, that to a certain extent, some people may be rebalancing. Again, this doesn't count the capital appreciation in the accounts.
Right.
And so it may well be that people are moving some of their gains from equity into bonds, which is a reasonable thing to do if it's done with a plan and on a balanced basis. But this probably goes beyond.
It goes way beyond that, because you figured that would have been true in 2007, 2008, 2009.
Yeah.
And in fact, you would expect the opposite, and yet you still had net outflows. But there's no question that after a 10-year great bull market, some of that is going to be due to rebalancing, for sure, which is going to look like sales. I hadn't really thought of that, Fred. Thanks for, that's why we have Fred. That's why we have Fred. But that's a good point. But to me, I read this as it's almost kind of like seasonally adjusted for all those factors. It appears to me that I have the statement, we're always fighting the last war, and we seem to really still be fighting the last war of the financial crisis. And it strikes me, I don't know about after the 20s and the 30s. I suspect it was true. And I think I've read that it's true that investor behavior, people become scarred after that. And I think after the early 70s, mid 70s, and even the late 70s, I think investors were scarred after that 50% decline in 1973, 74. And I'm reminded of that famous The Death of Equities Newsweek front page in 1979. Basically, it was kind of, I think, a manifestation of people were scarred at, a 15 or 16 year period where the market went nowhere with lots of sheer terror in between.
Yeah, and the other thing in this particular expansion, there doesn't seem to be a lot of people betting on particular areas like the tech boom and the 2000 and the 1990s and so on. So I mean, you don't see people saying, "Well, I'm investing 100% in whatever."
Right. We're not going to get out of our diversified portfolio and put our money in 3 companies that are run by 18-year-old boys that are billionaires for a day. They've never been in a room with a woman that wasn't their mother. And that's what we saw in the late 90s. Literally, people might even think, well, that's kind of a silly way to view the late 90s. That's what was going on. Yeah. That literally what was going on. And I think it takes, it appears to me, just from my history, the historical attributes of the stock market, and really taking deep dive back look, that it seems like every 15 or 20 years we get some sort of financial dementia as investors, and we forget about the lost decade and some of these things. And when you look around the globe, and you're right, we're certainly not in that. In fact, the data I just laid out suggests that not only are we not in irrationally exuberant period like we were in the late 90s, where people would just put their money in 2 or 3 tech stocks and everybody was going to get rich. But if I look at the last 10 years, there are some striking similarities to me. First of all, what has been the best asset class of the last 10 years? The largest U.S. growth companies. Well, now it's not to the same magnitude it was in the late 90s, the mid to late 90s. But suddenly global diversification looks like, well, that's been a disappointment. Anything other than basically the largest U.S. growth stocks has caused your returns to be detracted, not added to. So I'm sensing a little bit of this and a little bit of people suddenly starting to wonder, should I be diversified? That's the part I'm feeling again, not as near as strongly as it was when I was fighting for my life on this radio show, being ridiculed by telling people to stay globally diversified, stay diversified. And small companies include value companies, all these, it didn't look so smart at the time, but it was the difference between life or death financially over that lost decade. Right. And so I don't know if you guys are noticing any of that, but I'm starting to see it creep in, a question or two by clients suddenly about performance. And that's probably just the recognition that a globally diversified portfolio. I mean, what financial advisor would get on the radio and say, hey, we're in globally diversified portfolios, and they haven't done as well as the broad U.S. stock market.
David,
that's just reality.
David, you're even more into the international, aren't you?
Yeah, in my personal portfolio.
Yeah.
Oh, yeah. That's what I was talking about before the show, because I'm very heavily tilted towards small cap value stocks, which, all the research suggests over really long periods of time, they have higher expected returns. I have a good dose of emerging markets in there. And both of those things have done horrible for the last, several years relative to the S&P 500. But it's like, that really doesn't bother me, and I knew that was a possibility going into it. And I think that's the key. Is I was talking about this right before the show. Anytime you own something other than the S&P 500, your performance will differ from the S&P 500, and sometimes for the worse. Sometimes you're going to go extended periods of time where your portfolio does worse, even if it's something that maybe makes more sense than having a more concentrated large cap only U.S. portfolio.
Right. And I sent you guys an article. I think it was Mel Faber wrote it. I'll try to give him the proper citing next show, but it was fascinating. He did a deep dive historically, looked at the last 12 decades. And his point was, if you just focused on your own country and how investors tend to favor their own country, many countries, much more than we do in the U.S. The U.S. is about 55% of the global market cap. And David, I think you believe this, that people probably ought to have a portfolio that's more equal weighted around the globe. And we tend to be 30% international full time, but you can make a good justification and argument for it. Maybe it should be 50-50 between the U.S. and other parts of the globe. But he was showing that almost all of the U.S. Favorable returns above international returns over the last 4 or 5 decades were because of the last decade. But he tried to basically say that's generally hasn't been a good idea to concentrate all of your money in one country, not even your own. And he showed that 8 out of 12 decades, the globally balanced or market weighted portfolio has done quite a bit better than just the large U.S. companies. And he also went on, Fred, to mention that plus, it's not a good idea sometimes for practical reasons. Just look at the German market and the Russian market in the 20s and 30s and 40s.
The United States is unusual because of the stability, but if you throw in a couple zeros with Argentina or where it goes all the way from wherever it is to nothing, or Germany or Russia, that the compounding interest doesn't work very well.
Well, look at the Japanese market. It's certainly a major economy. And if you invested back in 1989, the Nikkei index was at 40,000. I think today, some 30 years later, it's still below around 25,000. So for the Japanese investor, it would have seemed natural to invest all or most of your money in the Japanese market only. Probably somewhat of a disaster from a retirement planning standpoint. If they'd just been 50% U.S. based, they would have had a completely different experience, and that's hard to fathom that when you're a U.S. citizen, thinking that, well, it's conceivable that with the Dow Jones being around 27,000 now, that 20 or 30 years from now maybe it could be lower. Unlikely, but it's a possibility.
Well, and I think the nature of holding a diversified portfolio is at all times, you're going to own something that you're kind of disappointed in, and you're going to own some of the thing that's doing really well. And at those times, you're going to wish you didn't invest in the things that aren't doing well and wish you put all your money in the thing that is doing well. But that's hindsight. You don't know in advance how that's going to work out in the future. And that's kind of the point, is what you don't want is to put all your eggs in one basket. And I think a lot of times, just because we deal with retirees, that's kind of where my mind goes. if you retired right in the beginning of 2000, so
Right.
you're going into the lost decade, you put all your money in the S&P 500. That was a really, really terrible start to retirement. You went 10 years with a negative growth of wealth.
Right.
Versus if you had an international portfolio, it still wasn't a great decade, but you had positive returns.
A globally diversified portfolio certainly wouldn't be, I wouldn't be very far off at all if I said a globally diversified stock portfolio would have been up 60 or 70% during a period where the Standard & Poor's 500 index had a negative 10% total return.
Right. And that can be the difference between, and I haven't run the numbers on this, but I wouldn't be surprised if you did go back and look at, maybe if you started with $40,000 of portfolio withdrawals
On a million.
on a million, I'm just pulling even just
Right.
a random number. If you were all S&P 500, you probably would have had to cut your
Oh,
portfolio.
no question about it.
withdrawal during
I've
that
done
time
those.
frame.
I've done those experiments over and over again. I've done historical audits, and that would have been a particularly brutal period. You would have had to be very flexible. You would have had to cut your, so if you were planning on spending that 40 or 50,000, you would have had significant cuts. And even today, your plan probably would have now be in much better shape, but that would have been a pretty tough decade versus even a disappointing 60 or 70% total return. And think of that as 6 or so or 7% annualized return. That's a completely different experience from a retirement planning scenario. When we talk about the sequence of returns risk, that's what we're talking about. If you just looked at one asset class, which a lot of people focus on, and that just probably would have had a really tough time, whereas the globally diversified strategy really paid off. We do have a text from Mike. Mike says, Mike in Champaign, I've been reading a lot about angel investing. According to what I read and listen to, angel investing pays out 10,000 times the average return of the stock market. I was told I'm wasting my money investing in a 401k. What do you know about angel investing, Mike in Champaign? I don't know about angel investing, but whoever told you you're wasting your time in investing money in the stock market is no angel. I can say that for sure. I mean, so we kind of have these two really strange concepts in one sentence. I was told essentially I should be angel investing and investing in all these startup companies, and I should not invest in a 401k plan. I mean, I've heard a lot of really bad advice over 35 years. I'd probably have to put that on the top 5 list.
Well, yeah, and this is something we talk about a lot in the office. People always turn things into either or decisions when they don't have to be. It's like, look, the way I would look at it, if I was advising a client and they were interested in venture capital or angel investing, I'd say you still want to put your serious money into your 401k and things is a diversified, low-cost portfolio. If you want to take a small portion of your investment assets and try angel investing or investing in venture capital, knock yourself out. Just don't do it with any money you can't afford to.
I always
lose.
tell people, I think visualizations always help. If you want to be an angel investor or your own venture capital investor,
Right.
whatever money you're thinking about doing that, think about driving between here and St. Louis, and every mile throw $100 bill out the window. And if that doesn't bother you, put as many of those $100 bills in that investment as you want.
Well, and I think the key is it's just the range of outcomes is really, really wide. Yeah,
Well, you can't plan.
You have
right?
the chance of investing in a company that does really well, and in that case, yeah, you will have much higher returns than just the stock market average. But you also have the chance of investing your money in a company that goes nowhere, and you lose 100% of your investment.
There's something called deal flow too that I suspect that the person that wrote in and all of us here don't have deal flows. We don't have the best private equity people coming to us.
No.
Yep.
So if we wanted to play that game, we're not going to get the Amazons or the in the old days Microsoft or whatever. We're going to get the real dogs. And so even if you're a player,
which means you're a $1 billion fund that has
and in the case of Warren Buffett's not exactly in this case, but we talked about the bet very often that he bet hedge fund person
Ted Sides
that the I don't know, Standard & Poor's or whatever would beat almost all the hedge funds. They did, which is true, but they also beat Warren Buffett.
Yes, they did. Now, as I recall, I don't think it's even a lock that private equity, for example, has a higher expected return than the S&P 500 has done all that much better.
No, it's not. So I think it depends what you compare it to as well. So yeah, I think if you compare it to the S&P 500, which is large companies that are growth oriented for the most part, it has had a higher expected return. But if you compare it to small cap value companies, which those are kind of the types of companies that end up getting bought by private equity firms anyways, I think if you look at the research and there's a guy named Larry Swedroe, he wrote a great book called The Only Guide You'll Need to Alternative Investments. And he talks about venture capital and private equity in there. So if you want more information,
That's a great book,
a great book to check out. And that's where I'm getting some of this information. But my takeaway, and I don't remember the exact numbers, was private equity has similar expected returns to small cap value stocks, but you have less liquidity. There's always that liquidity issue, and the range of outcomes is almost even a little bit wider than just buying a small cap value mutual fund.
Yeah, someone said that if you can't be in the top tier, the top quartile or quintile with private equity, you don't want to play. And everyone assumes, well, I'm going to choose the private equity people who are in the top whatever, but that's not easily done.
And that trickles down to even mutual fund investors say the same thing, right? Well, I'll pick the good ones.
Yeah.
If only it was that easy. Here's what I'm trying to just understand, Fred, at all times. I just wrote a new ad that will run on WDWS, I think. And basically, I go back to the 30 years I've been doing this show. And so I went back and I looked to see, well, where was the Standard & Poor's 500 index in the year that I started the show, which was 1990. And I defaulted to the beginning of the year. And where is it today, et cetera. And I'm trying to think of who would want an alternative to this. Over the last 30 years since I've been doing this show, the Standard & Poor's 500 index has increased by a factor of 8.5 times. It's 8.5 times higher than it was 30 years ago. The dividend income stream is 5 times higher. Meanwhile, the cost of living has doubled. And I calculated that. Now, keep in mind, you can't buy. So here's my regulatory part. You can't buy an index, but you can buy an index fund. I'm not trying to make any quantum leaps here. So I'm not suggesting that these numbers are exact. This is for educational. But if you were able to buy the Standard & Poor's 500 index like it was a mutual fund at the beginning of 1990, today your dividend income would be 16% or be north of 16% on your original investment. Why is it, Fred, or you guys, why is it that over and over and over again, people continue to look for alternatives to that?
Well, people are selling them on the hope they'll be able to do it. And this is not just amateurs. I think I talked about last time that almost all pension funds, if you go back 10, 20, or 30 years, would have done better, 60 in index equities and 40 in bonds. And they've done even fantastically well. They've done 70-30, but they've done all kinds of, real estate, direct lending, hedge funds, private equity, so on. Again, that's not to say there'll be maybe in the future the world will change, but it's not clear that it's going to.
Yeah, I just find that fascinating. Why people keep looking. I guess it's because when I talk about that 30 years, I'll get to you a second. And it didn't come easily. You had to escape the .com crash and not buy into that, which was very compelling at the time. I mean, you were made to look foolish if you were suggesting that people should stay diversified in their investments. And then, of course, you had to ride through patiently, which is not so easy, during 7 bear markets, which are declines of 20% or more, 2 of them being the second and fourth worst ever, 50% off plus. So we can talk about, I guess, the stock market being an 8.5 times higher and dividend income stream now 16% on your original investment. But it would test anybody's mettle, and most people can't do it.
Yeah, very few people actually do that. So passive investment is only half the story. Passive saves you a ton of expenses, but if you come and go at the wrong time, you lose a lot of that.
Okay, so we have an email. It doesn't say from whom. It says, "Good morning. I am 60 years old and have $50,000 in an IRA and $17,000 in a retirement annuity. I would like to roll these over into something that has a 7 to 9% annual gains or more. Can I do this and avoid taxes and/or penalties? Thanks very much. I appreciate your service with this program." Okay, well, there's a couple of questions embedded in there. first, let's take the easy one. Can I roll it over into something and not pay taxes? You guys want to weigh in on that?
Yeah, sure. I think you said his 50,000 is an IRA, correct?
Correct.
Yep. So within the IRA, you don't even have to
Oh,
roll it.
that's right. It's already in the IRA. Maybe it's the retirement annuity.
Okay.
That's probably capable of being rolled into a qualified, maybe IRA, something like that.
No, there might be like early surrender charge penalties,
Right.
Just depending on when he bought the annuity
But in
and
other words,
how it's
he
structured.
doesn't have to
but-
worry about taxation, I don't think. Okay,
You could change your investment selection within the IRA with as long as you're not selling out of it and distributing the money, and invest in something that targets for that type of a return
okay.
without a tax consequence.
The second part, I would like to roll these over. And I think this is a very common question and a very common thinking, right? And it sounds like an easy question, but I'm not so sure the answer is always it depends, right? Can I roll these over in something that has a 7 to 9% annual gains or more? Now, keep in mind that this is probably a question that 80% of the people might ask us on any given day.
And I've gotten phone calls on our office phone with people asking almost the exact same thing. And my answer is always, well, there are investments out there that have an expected long-term average return in that range, but it's not going to be every single year. Far from it. There's going to be years where your portfolio balance declines substantially. Anything that has that type of expected return is going to have a lot of years where the return is negative. And so I think the key is to know that I don't think there's anything out there where you can guarantee a 7 or 9% return year after year after year. It's like, yeah, you can have a portfolio with that expected return over a lot of years, but even over a long period of time, you're not sure exactly where your return's going to end up.
And even if you do fixed income, there's a default risk, which is similar. I think
Yep.
we got a call, I don't know, probably a couple of years ago about someone saying, well, a church is selling bonds for
Church bonds.
9% or 7% or something. Their bonds are supposed to pay that much. And that's fine as long as the church generates
It's
the
as
money.
good as the church.
But I was going to say, if someone's looking for a stable return where they want it year in, year out, the only thing that really can do that is fixed income, in other words, bonds. And you're not going to get 7 to 9% in bonds. You're going to get probably around 3% or maybe a little higher, depending on the type of bond and the quality of the bond that you buy. But the problem with that is, as we talk about time and time again, after taxes and inflation, that nets out to maybe one or no returns. You just tread water. So there really isn't a way to guarantee a return that high with equity.
And I would
Certainly
even
not in
go-
today's environment.
sorry,
And
bonds.
I tend to think the question under that question, and I don't want to speak for this person, but many times when they call us and they ask this question, the question under the question is, can I get a stable 7 to 9%?
Yes. Yep. Exactly. And the answer to that is no.
Well, if the person already has an annuity and presumably it's less than that, the answer is probably no. And again, it's kind of piling on, but there's a question about having an annuity and an IRA account.
True. I mean, if it's a retirement annuity, it can stand as itself if you're going to keep it in that retirement annuity. And many times particularly if it's like a University of Illinois. I mean, I wouldn't convince anybody or try to convince anybody to move that into an IRA.
But even a bad investment though may something you'd never do again, or
Right.
you may not necessarily want to terminate it.
Now, these guys don't remember, Fred, but it was not unusual. I mean, we've had a lot of periods in time when you could get 7 to 9% in a certificate of deposit,
Right.
and a brief period when you could get almost double that. But
Right.
The first half of my career, maybe the first 2/3 of it, 7 to 9% CD was not unusual. It wasn't unheard of. It was
But
fairly
you're
common.
talking about maybe 5%, 6% inflation.
Of course.
And you're paying tax on the inflationary portion of the.
Great point. And so while we dream about a 7 or an 8 or a 9%, or even these days, a dream CD would probably be 5%. If you have a 5% CD, you probably have built in 3% or so inflation. Now you also have to pay tax on that 5%. So it's lop off 1 and say you get 4 after tax. Now the invisible robber. So the tax is the visible robber, takes 1%. I'm just being casual here. And so now we have 4. We think, well, that's pretty good. 4% CD is pretty good. Well, it costs 3% just to live the next year more. So you're really netting out 1% real return. So even though be careful, if we had 7 to 9% CDs today, it would not really be any more of a bargain than a 2 or 2.5% CD is today relative to inflation. There might be some
Yeah,
differentiation.
I think the caller's issue is just a kind of fact of life that there's no certainty at
Right.
7%.
So-
the only way you can achieve that is to take a degree of risk.
Yeah, you
which
might
may
be
or may not want to do.
For instance, a global portfolio of 60% stocks diversified around the globe and 40% high quality fixed income certainly has an expected return in that area. But I would say periodically, you better be prepared to see that money, that your portfolio balance decline by 10 to 15%. And if we get into something like 2008, 2009, even that portfolio lopped off more than a third of its value temporarily. It just never feels temporary when it's happening. So there's no free lunches out there. We wish we could design a real return of 7 to 9% that was guaranteed, and get real return meaning net of inflation. And that's the only return that's important. So I'm sorry. Yes. And so the answer is, the question is, you don't have to really worry about taxation as long as you follow the rules. And yes, there are plenty of people that can design, including yourself, a portfolio strategy with that expected return, but it's going to have somewhat significant fluctuation, and whether that's tolerable by you as the investor, only you can decide. Does that sound fair, guys?
I think if someone comes to you and tries to convince you that they have a product that will deliver that guaranteed 7 to 9%, you should be very, very skeptical.
And over the years, I've seen those. Usually they're garbage. Not always. I mean, back when CDs were 6 or 7 or 8, you could buy a fixed income annuity, deferred annuity for 7 or 8 or 9. That was a square deal.
Right.
But what's going on today, and has been going on for at least 10 years, if not during my whole career, but certainly in the epic low interest rates, historically low interest rates, people crave a higher yield or interest rate or guaranteed return. And there's plenty of folks out there that will create shenanigan type investments that promise those things, but you have to follow your gut feeling, and it's certainly worth a second opinion at all times if somebody's pitching. The one thing I think of right now that I continue to see way overcooked are these fixed income annuities, where basically the agent or the salesperson tells the person you can have the returns of stocks without the risk. And of course, that's just
Well, and I guess even just being a little bit nicer to the insurance agent, they might not even be saying that. They might be saying a more nuanced, slightly more true version of that, but that's what the client hears.
That's what the client hears, in all fairness. But I think you have to go out of your way and say, now, look, here's the reality of this product. I haven't seen that promoted yet.
Yeah.
A realistic expectation outlook for a fixed income annuity by any salesperson ever. I'm not saying it doesn't exist. I've never seen it.
They really confuse people too, because I had someone stop in just for kind of a consultation, and he mentioned on the phone, well, I have something in this Roth IRA, it gives me 10%. I'm
Right.
just thinking off the top of my head, okay, well, that sounds too good to be true, so it probably is. But hey, bring in your documents and we'll go over everything. Well, it was an equity index annuity with an annual cap of 10%.
Right.
It doesn't mean that's what you're going to get. It means that's where you get capped out. So if the, whatever the index it was tracking and crediting based on, if it earned 20% that year, you'd get 10. So it was more of a limiting factor, not like this return you're going to get. But if people don't, they're just very kind of convoluted investment products.
Designed to be. I'm very cynical on
And
this.
plus,
as
you're starting in a hole, though, because you're probably paying 5% to get in the game or more. So
to me,
you have to win back what you pay for the fees plus.
To me, it's look, people distrust financial people. They distrust Wall Street. It's all for good reason. I'm cynical on this. Wall Street and its minions are happy to create complete crap packages that are basically harmful to people and market them as though they're just something that people need. I think most variable annuities that I see qualify for that. All fixed, or what they used to be called equity index annuities, qualify for that. I think if anybody offers you a variable annuity that's a retail annuity, and so if they said, hey, go buy Vanguards, I'd probably give them a pass. But outside of that, I'm talking about the ones that are sold. Variable annuities or fixed income annuities, fixed indexed annuities. Okay, these are the ones that are linked to the stock market. You have a ringer on your hand and they disqualify themselves. That's just grouchy old Paul. It's after 30 days of vacation and I'm still grouchy about this stuff.
Well,
I'm
and
glad you took that vacation. Could've
I
been worse.
just I just like to always say, give things a common sense check. If it sounds too good to be true in the financial industry, it probably is.
I want to go to the next, because it's so important, the next section. Before I do that, you're listening to Paul Ruedi's On the Money radio show on WDWS. I'm here with Dr. Fred Gertz and certified financial planner professionals Ryan Repko and David with Ruedi Wealth Management. You can call in with your questions at 356-9397 or text us on the Castle Heating and Cooling text line at 351-5357. So online scams is one of the things you guys have been writing about this. We're seeing more and more of it, Fred. It's a pretty wide swath, and they seem to really be geared towards people in the retirement age and above. So we see them a lot, and what I have found, scammers are so why it works. These are, and I think one of you guys wrote somewhere, hey, that's their full-time job. I mean, you're good at anything if you do anything long enough full-time. And I'd like to say that, and I've known people that have fallen for them, and I'm quick to say, look, if you've fallen for one, it's not your fault. You might say, well, yes, it is. No, this is a human nature thing where these people are very good at milling through and sifting through people in their emotional states of time, and they're just that talented. The sad news is once you've done something, we're going to get into some of them here briefly, is typically it's too late. The money's gone. Once that money is sent to somebody or paid to somebody, that money's gone. Ryan, why don't you start us out on the first one, because you had a fresh one, I think, recently.
We had a few. Sadly, it's just we would intervene, but it's like this is such a common thing that your email is just the front lines of battle for so many of these scams. And I think we try to warn our clients too, and anybody who's listening, is that basically be highly, highly skeptical of any email coming into your inbox that you don't know the sender. And even sometimes the sender can be compromised and they can, in fact, be hacked. And a hacker or a scammer can send an email on behalf of someone you think is your friend or a family member, and turns out to be someone who's trying to take something from you or earn your trust in a false pretense.
Well, how come last Friday when I sent you that email that said, do a quick task for me, you didn't do it? Were you just being belligerent?
I think best policy is to give your father-in-law a pause, and you don't always listen to him,
So tell people about that most recent one you had.
So just as you said, I had an email come through. It on its face looked like it came from you. It said Paul Ruedi. It had the Outlook logoing that said PR for your initials. So it looked 100% authentic, but a quick look at the email address quickly showed that it was not your email coming to me. It was a person's name with the fake email attached to it. So you always have to check the email. Don't just do a quick glance. And the problem with this is they're targeting someone who might quickly look at their phone and gets email by phone rather than their computer. Because when I looked at the same email by phone, there was almost no indication without looking even further into the email that it came from anyone other than you. Because I could have easily looked at my phone, hit reply, and said, sure, what do you need? If I hadn't been diligent and aware of these kinds of things.
And what are they looking for when they send that?
They're
ransomware?
They could be looking for any number of things. They could be looking to try to get some money from you. They could be saying, hey, I need money for this. And this kind of
send me a quick $10,000 or...
Right. This could be a client asking for it. Or for you, it could be, hey, I need you to move some money from this account to the next. It's called a CEO attack or CEO scam, being that you're the CEO of our company. And they obtain your email some way online, and then they try to pose as yourself. And in this case, thankfully, it wasn't one that we fell for, and you just always have to be skeptical.
Well, and then when it comes to ransomware, and that seems to be the one we see most advertising for and see most articles about, the city of Atlanta was hobbled by a ransomware attack in 2018, and it wound up costing the city more than $2.6 million to recover. But we've seen them just in the smaller versions of this, the one-on-one individuals. You had one not too long ago.
Yeah, we did just about, I'd say 2 weeks ago, maybe. A client called me and said, I've been hacked on my computer and I'm going to need, several thousands of dollars to pay and I say, quote unquote, tech people to help me fix this issue. Well, this was all intermingled in with the scam, is that the people who had taken over this person's computer were also posing as the folks that could help him free up the computer, and for several $1,000s, they could fix it and everything would be fine. It's just a scam to extort money. But as someone who has been trained to look for these things, I was able to ask about this a little more and drill into it and realize that this was almost certainly like 99.999% a scam. We were able to stop this kind of further money movement and lock down accounts and make sure that we took those kind of steps.
And we've spent quite a bit of money and resources to prepare ourselves and fight against these and trying to recognize them. So there's firms that actually try to help companies be on guard for these. We've enrolled in some of them. Do you think those have been worth it? Have those helped you guys, do you think?
Yeah, I think it just helps you maintain a healthy skepticism. And I think the practical takeaway or practical advice for managing an email inbox is, like Ryan said, anytime you get an email that you weren't expecting, or if it seems kind of suspicious, like they're asking you to take immediate action or open some file, and you're not 100% sure why that person sent it to you, is don't click on it. And that was kind of the premise of this. That one of their big takeaways is just maintain that healthy skepticism, and just take a second to look closely and think about things before you click anything in the email.
And a lot of times, beyond ransomware, then it kind of gets into relationship driven situations where people are trying to establish relationships with people online, and then they gain their trust and confidence. And now all of a sudden they're asking them to send them money or invest in this or that. You guys, what's your take on that?
I think that's the scariest one of all, because it's no longer just posing as someone else, but rather kind of playing the long game, saying, I'm going to invest myself and my time as this scammer into a relationship over the computer, possibly even by like a video chat. And so you actually build real feelings with the person, and you feel that as the person who may be a client who might potentially be scammed, you feel like you know this person. You feel like you have a legitimate relationship like you would with a family member or friend, and that's when it's dangerous. And I don't know if Dave want to talk about some of the things we've seen with this example of a scam where someone tries to develop this type of relationship, and how it can impact you and your mental capacity about spending or giving out money.
Yeah, I mean, it's kind of sad, but one of the biggest targets are widows and widowers who are on online dating sites. And then people will basically convince them that they're, someone who's a legitimate participant in the online dating site, and basically kind of like establish a relationship with you, and then eventually some way or another convince you to give them money, whether it's for like an investment or to help them out because they're in financial need or whatever. And they really do. They prey on people when they're in their absolute weakest state after the death of a loved one.
And Ryan, I know you spent some time investigating, some of these issues with Schwab. We use Charles Schwab as a custodian for all of our client assets, or 99.9 probably percent. What was your takeaway from some of those conversations? Because they deal with this on an everyday basis.
Yes, what was interesting to learn is Schwab has a person whose full-time job is to assist firms like ourselves, registered investor advisors, with clients who have either been a victim of a scam or could be in the process of it. And they told me, this person said that the scams don't end at trying to get money from maybe a client's account. They'll actually go a step further. If the door to money from an account is closed, they'll try to open up another door and say, well, how about you send me some money through like a credit card expense? Or you say, here, pull out cash from the credit card, or even worse, take out a mortgage on your home or a home equity line of credit. So they're not going to stop once or twice. They're going to pull every single option that they can. And a lot of times, like I think David said, is they may even say it in the context that they're going to pay this money back, because again, they've built this relationship, this fake relationship, but a relationship. And so the person who's being scammed feels like they're just being a good person by helping someone out in a time of need. And I think, Dr. Fred, were you trying to mention something?
Well, it's a different kind of scam, or if you maybe not a scam, but at least a deceptive practice. I get emails occasionally, and they'll have a big Parkland logo or University of Illinois logo saying investment seminar being held certain place. It turned out that someone is able to acquire a room at Parkland or at the U of I. The U of I has nothing to do with it, or Parkland has nothing to do with it aside from somehow having a room open, and it suddenly becomes a U of I seminar or a Parkland seminar, and it's not, and it's against the rules, but the two institutions don't enforce them very adequately. So you have to be careful.
That happened with SIRS.
Well, SIRS is different. It's not. SIRS has a different kind of thing. You get a
Well, what I mean, someone was
right.
putting their logo.
Yeah,
or something.
you get your retirement's under attack, and they have a SIRS logo there saying, and this is a way to deal with it, or we can help you with your retirement benefits, that kind of thing. So again, SIRS is more diligent about stopping that than I think than the U of I and Parkland is, but it's still, so you have to make sure that they're not just using the name as a come on.
So you're saying maybe I should get a room at Harvard, and then I really go to the top seminar. And then what about here's one I've seen, guys, and this is one to really be on guard for, because this is really common, and this is one that seems to work pretty effectively. It's a family member, typically a grandchild, who's in trouble, and they call grandma and grandpa.
Yeah, so this one actually happened to my wife's grandfather. Someone called and posed as my wife and said they were in trouble with the police, and it was because they found drugs in her car, was the story, and they needed him to post bail. But the way that to post bail was to buy a bunch of iTunes gift cards, and so that was kind of the tip off. And unfortunately, he didn't get caught in that. But it's just amazing how bold some of these strategies are, and that there is a lesson there that a lot of times these scammers want their compensation in some weird format, like cryptocurrency, iTunes gift cards, or I guess some of them are direct wires. Which, but yeah, that's an immediate red flag.
Yeah, I've had several clients come into my office saying, "You got to help me. My grandson's in trouble," and and I'll say, "Let's get him on the line," and then I intervene, and it's click real fast.
There's kind of an economic theory about how these outlandish things work. I mean, you get an email from a Nigerian prince who has $1 million he wants to liberate from Nigeria, and you can tell in a tenth of a second it's totally crazy. So the question is, why do you do that? Well, the answer is the people that respond to that don't know what's going on.
Exactly.
So they make it outlandish to start off with, and it screens out the reasonable people, and the unreasonable people then respond, and it shows that they're open for this kind of fraud.
So the Dunning-Kruger effect, you have to be competent to know you're incompetent.
Well, and I think they're just playing the game of numbers. They send out millions and millions of these emails, and it's like, okay, if we get 0.01% of people to respond,
it can be big dollars.
But they know that the 0.1% or 0.01% are highly gullible.
Oh, yeah.
They probably get them through a filter, and they eventually go, okay, once they get through this level of filter, we're going to get some money.
So I was thinking we could go into some just practical advice.
Yeah, please do.
So first and foremost, like I said, have a healthy skepticism when it comes to really anything, but especially your email inbox. And if you're not sure, like even if you have a shadow of a doubt, pick up your phone and call the person directly and say, hey, did you send me this email? And is this legitimate? And find out. And on that note, don't send them an email. Don't like reply to the email, because their email could be compromised. If they provide a phone number in the email to call, don't call that number. Look it up separately online and call. But if it's one of those, like you'll get some that pretend to be Amazon.com or something. Don't call the number for Amazon's support or service in the email. Look it up separately.
Go to the Amazon site, verify. Get their true 800 number, and explain what's going on.
And then I think a final one is just don't send money to anyone you haven't met in person. And honestly, on that note, because I was thinking of an additional one, is we're focusing on online scams, but a huge issue is just elder abuse in person.
Right.
People who know the person. A lot of times it's family members. And I would say, when you're older, be really careful. Almost don't give your money to anyone.
Yeah. One of the things we're going to is getting a trusted contact for every client. That's one of the things I'm mandating here shortly. We started to do it, and that is, I think every retiree at least ought to have somebody that the advisor is allowed to call if they suspect if something doesn't feel right. Because otherwise, your hands are tied legally when you think something might be going on and you can't really do anything. But if you have this trusted contact that they're not allowed to do any transactions or do anything in the account. You're just allowed to reach out to them if you suspect something is a foul. Yeah, Fred.
One more, really obviously, maybe these are so obvious we didn't think about them, but no one's going to call you from Social Security, the IRS, or the Illinois Department of Revenue. So if you get a call that asserts that they're from those people, that's not true.
Automatically click. They don't do that. So Social Security is not going to call you. The IRS is not going to call you. The county jail is not going to call you. You mentioned one other one. Illinois Department of Revenue. They're not going to reach out to you by telephone.
One other thing that I learned from you many years ago, if you're making an investment, don't write it to a person, write it to
so if you're looking for what Fred's talking about is when the big scammer,
Bernie Madoff.
The first client that brought it to my attention, this has been years ago now, said, what do could this happen to me? And I said, well, I don't know anything about it, but I can tell you this. The only way that happens, that somebody gets their money stolen from their advisor, is if they're what's talking about taking possession or custody of those funds themselves, and they're commingling the client's money with their money, then all bets are off. So when new clients always want to write a check to Ruedi Wealth Management, I said, as much as I would like that, it's not in your best interest to do that. Make sure you write that check to Charles Schwab and Company. They are the actual custodian. That's where the money is. It's a little corny, but I'll say, no, your money's not in that drawer over there. Your money's at Charles Schwab. It's in your name, your tax ID number. So this custody issue is very important, Fred, because that's a way to really lose big bucks. Is if it's the John Smith Investment Company and you say, well, who do I write the check out to? And write it out to John Smith Investment Company. Probably ought to ring an alarm. It should be somebody outside of that, a major custodian that you know of and aware of. Could even be a local bank, but somebody outside of that person. I think that's key. Yep. What else, guys?
I would say, just for other helpful tips, again, be very skeptical. People are out there to take your money, and the industry is a multi-billion with a B, billion-dollar industry for scamming adults and older adults. So it's something you want to look out for. And then lastly, don't be afraid to ask somebody else for an opinion. This is what so many scammers are hoping for, is that you don't ask questions, you don't talk to somebody, and they want you to take quick action. But if you take a minute to stop, think, and then reach out to someone who is a third party, a family member or a close friend, somebody just to give you a different perspective who is not part of this A and B conversation, that can have a huge impact on you making a wrong decision.
It's that tap of the shoulder. In our most recent client newsletter, I reiterated, look, if anything seems, anybody's coming at you for any of these reasons, please call us first before you do anything. 24/7. I don't care. Call me in the middle of the night if the grandchild is saying I don't care. This is a real problem. This ransomware tends to be the biggest one. It's the most common one. And I think a lot of people don't understand what they're trying to do is get you just to click on something. And that is a link that basically sets up this little program that allows them to go into your computer and basically take over. So that's why you're getting these emails, is they're hoping there's something within that email that you will click on. And that's what sets off this little war. Go ahead, Ryan.
And it could be something as simple as an unsubscribe link at the bottom of the email. So if you're tired of getting spam mail that you're not wanting to have, it says unsubscribe, the real link could actually be the Trojan horse, so to speak, that installs these back-end programs that spy on you or take over and ransom.
The issue is, if you suspect something, call somebody that's independent. It can be a family member. It can be your financial advisor. Is a perfect person, because they probably have some additional resources that they can get to really quickly. And I think that's the key, is acting quickly before the damage is done. But this probably sounds like a scary thing, but it is a scary thing, and we're seeing it more and more. We are on high alert at Ruedi Wealth Management. I mean, we are so skeptical that even some legitimate emails sometimes don't get all the way through. But you just can't be too careful here. It's one thing, there's an old saying, it's harder to stay rich than it is to get rich. And this is just another layer of why it's harder to stay rich, because there's a lot of people out there that want to do harm to you and steal your money. There's no question about that. Fred, well, I guess no recession. Everything looks rosy to me.
It sounds like, or it seems to be a period of calm now. No big issues. The interest rate business is sort of settled now.
And
We
nobody's
have
really rattling about recession.
we have
these
a
days.
budget. No one's worried about too much about recession. Corporate profits aren't great, but we're hanging in there. So
Okay. Well, thanks, Fred. Thanks for listening to Paul Ruedi's On the Money radio show. We'll be back the second Tuesday of August. Thanks for listening.